Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Meritage Homes Corporation Annual Report. Meritage Homes Corporation offers a wide range of businesses and services that cater to the needs of homebuyers. The company's primary business is designing and building single-family attached and detached homes for entry-level and first move-up buyers across various states. In addition to its core homebuilding segment, Meritage Homes also provides financial services to its customers. This includes mortgage services, insurance, title insurance, and closing/settlement services. These services are designed to make the home buying process more convenient and streamlined for its customers. The company operates in multiple states across the United States, including Arizona, California, Colorado, Utah, Texas, Florida, Georgia, North Carolina, South Carolina, and Tennessee. Its extensive reach allows it to cater to a diverse range of customers and provide them with a comprehensive suite of services. Overall, Meritage Homes Corporation is a one-stop shop for homebuyers, offering everything from land acquisition and development to mortgage services and title insurance. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause Meritage Homes Corp's stock price to increase. Meritage Homes Corp is one of the leading home builders in the United States. The company's stock price has been influenced by various factors over the past year. One possible reason for its slight increase is the improving housing market conditions. As the economy continues to grow, more people are looking to buy homes, which can lead to increased demand and higher prices for Meritage Homes Corp's products. Another factor that could have contributed to the stock price increase is the company's strategic business decisions. Meritage Homes Corp has been expanding its operations into new markets, diversifying its product offerings, and investing in technology to improve efficiency. These efforts may have helped the company to better compete with its peers and attract more customers, leading to higher sales and revenue. Additionally, the company's focus on sustainability and energy-efficient homes may also be a contributing factor to its stock price increase. As consumers become increasingly environmentally conscious, Meritage Homes Corp's emphasis on green building practices could be attracting more buyers who are willing to pay a premium for eco-friendly homes. Finally, the overall performance of the home building industry as a whole may have also contributed to Meritage Homes Corp's stock price increase. If other home builders in the industry are experiencing growth and success, it can create a positive sentiment among investors and lead to increased demand for shares in companies like Meritage Homes Corp. Meritage Homes Corporation maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Meritage Homes Corporation trades at a higher price-to-earnings ratio of 13 times and a lower price-to-book ratio of 1.06 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 28% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.13%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be attributed to several key factors. Changes in interest rates have a significant impact on housing demand and mortgage financing, which can either boost or hinder revenue. Local market conditions also play a crucial role, with economic performance, mothballing communities, and impairment charges affecting revenue. In addition, borrowing costs such as higher interest rates on the credit facility can increase variable rate borrowing costs, further impacting revenue. Deposits paid related to land option and purchase contracts can also be expensed if land acquisition is terminated or no longer considered probable. Accruals related to real estate development and construction activities can decrease, indicating a decline in revenue growth. Revenue recognition policies, such as recognizing revenue from home closings, land closings, and financial services when specific conditions are met, can also influence revenue. Furthermore, remaining performance obligations, like estimated future insurance policy renewal commissions, can impact revenue. These factors contribute to the varying levels of revenue growth or decline across different regions and segments. Net income experienced significant fluctuations between 2023 and 2025. Initially, it decreased by 42.4% to $453 million in 2024, followed by a more substantial decline of 58.3% to $584.6 million in the same year. However, there was an increase from $738,748 to $4,611,900 in another instance. Furthermore, net income decreased from $786,186 in 2023 to $453,013 in 2025. The changes in profit margins were also notable. Home closing gross margin decreased by 520 basis points to 19.7%, while adjusted home closing gross margin decreased by 130 basis points to 20.8%. Additionally, company-wide home closing gross margin declined from 24.9% in 2024 to 19.7% in 2025. The reasons behind these changes were multifaceted. Increased land acquisition and development activities, as well as construction activities on a greater number of homes under construction, contributed to the decrease in net income. The decline in profit margins was attributed to increased utilization of financing incentives, higher lot costs, and charges related to terminated land contracts. The impact of external factors such as rising interest rates, decreased mortgage availability, and high inflation also played a significant role in affecting home sales and cash flow. These factors increased the costs of land, construction, labor, and materials, further contributing to the decline in profit margins. The company's financial performance has shown significant improvement over the past year, as evident from its operating cash flow. In contrast to the previous year, when it reported a net loss of $227.6 million, the company has now achieved a positive operating cash flow of $118.3 million in 2025. This marked shift indicates that the company is successfully generating sufficient cash from its core operations, setting a solid foundation for future growth and stability. The company's debt level has shown some fluctuations over the past year. According to the financial reports, total liabilities increased by 20% and senior and convertible senior notes, net increased by 38%. Additionally, total debt rose from $1,306,535,000 in 2024 to $1,804,726,000 in 2025. However, these increases are not necessarily indicative of a significant change in the company's overall debt level. Interestingly, despite the increase in debt, interest expense remained at $0 for the period under review. This suggests that the company may have managed its debt effectively, minimizing the financial burden associated with servicing its loans. The slight increase in aggregate principal and estimated fair value also indicates a minor adjustment to the company's debt obligations. Overall, while there are some changes in the company's debt level and interest expenses, they do not appear to be significant. The company has made several significant acquisitions and divestitures over the past period. In terms of acquisitions, the company has entered into contracts to purchase approximately 21,764 lots with a total value of $1.3 billion. Additionally, they have acquired raw or partially finished lots, land for development, and purchased various types of land parcels. The company also has option agreements in place for further land acquisition. The total number of lots under contract or option is around 36,329, valued at approximately $2.1 billion. These acquisitions are expected to provide the company with a significant amount of new land to develop and sell homes on. On the other hand, the company has also made some divestitures. They have terminated certain land positions to release capital, which resulted in a charge of $39.4 million. The company is also considering potential future divestiture of mothball communities, where they may sell off entire communities that are no longer viable. Furthermore, the company has sold homes in various communities and disposed of some or all of the land owned in these areas. The company's financial activities have been transparent in its reports. One notable aspect is its commitment to returning value to shareholders through dividends and share buybacks. The payment of $121.1 million in dividends in 2024 and 2025 demonstrates a consistent approach to rewarding investors. Furthermore, the company has also engaged in significant share buyback programs. In 2024 and 2025, it repurchased shares worth $125.9 million and $295 million respectively. This indicates a deliberate effort to reduce its outstanding share count and potentially boost earnings per share for existing shareholders. The presence of an authorized stock repurchase program with subsequent authorizations on multiple pages underscores the company's commitment to this strategy. Additionally, the mention of federal excise tax on stock repurchases on page 82 serves as further evidence that the company has indeed bought back shares. Concerns about inventory buildup and supply chain disruption are evident in various sections of the report. Inventory buildup is a pressing issue, particularly with regards to land inventory valuation, page 44. The decrease in order backlog, page 35, suggests that there may be too much inventory on hand, which could lead to higher overhead expenses due to increased spec home inventory, page 39. Supply chain disruption concerns are also present, including shortages of subcontract labor, page 15, which may delay construction schedules and increase costs. The significant decrease in West Region backlog, page 35, is a positive sign, but the increase in deposits on real estate under option or contract, page 41, indicates potential supply chain issues. Terminated land contracts and associated write-offs, page 66, further suggest some level of supply chain disruption or inventory management issues. Overall, these concerns highlight the need for careful management of inventory levels and supply chains to mitigate potential disruptions and costs. That concludes the financial summary for Meritage Homes Corporation. Feel free to comment below, and I will be happy to answer them when possible.